Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is that day of the year. It's Halloween, the 31st of October, 2023. We got a bit of a scary show coming up. Many of you know I've talked about renewable energy, EVs, electric vehicles, a lot over the last couple of years. A lot of stocks have done very well over that time frame. Everything from Tesla to battery makers. But the news as of late has been a bit tricky. Some negative news coming out related to EVs. We're going to dive into all that, what that means for your portfolio, what it means for automakers and anything related to electricity going forward into 2024. All that and more coming up right now on Making Money. If you are focused on the AI market or chasing AI stocks, you must pay attention. Today, I'm urging you to look at another tech opportunity. And while it isn't AI, McKinsey says that this sector could grow by 30% every single year until 2030. I'm talking about battery metals. I first identified battery metals as a huge opportunity in 2009. And since then, lithium-ion battery prices have soared 900%. But now, with EV adoption accelerating, I'm urging folks to get in on a handful of battery opportunities. To help, I've released a brand new free report, the 2024 Battery Boom. In it, you'll find all you need to know about the coming battery metal surge. If you're a tech investor or a megatrend investor that's looking to cash in on a billion-dollar trend, you can't afford to miss this. Just visit 2024batteryboom.com to get a copy of your free report right now. That's 2024batteryboom.com for your free report. So as I mentioned, we're going to talk about electric vehicles today. We're going to talk about clean energy and some of the really negative news that's come out as of late and really what that means for any investments, not only today, but going forward. Is this trend over or is it just a bit of a slowdown? We'll dive into that in a minute. However, before I jump into that, we need to catch up just on the overall market itself. Keep in mind that we have moved into the S&P, the pullback that we had in the last week or so, that culminated near low in the last week or so, put us into the first correction of 2023. And what a correction is, it's a pullback of 10% or more from a recent high. So that means that the S&P is now down 10% from its high. So let me show you a chart here, folks. This is the pullback of the S&P off the high. This is over the last 12 months. As you can see here, I put three different ETFs up on here. The purple line is the S&P 500, heading into today down about 8.9% on a closing basis, though we did dip below that 10 line barely, you can see on the right-hand side. So we officially did go into correction territory for the S&P 500. The other two ETFs I threw on there, one, that orange line is the QQQ, so the NASDAQ 100 ETF. That also moved into correction territory in the last week. But you can look back and see that actually moved into correction territory last year, December, January as well, before rallying back to a new high from there. So both sitting right around that correction level. And the third line I put in here is the RSP, and that's the equal weight S&P 500. And keep in mind that the S&P 500 is market cap weighted, meaning the large stocks, the Mag 7, they talk about the Magnificent 7, they have a higher weighting. So if they do better, the S&P holds up better and vice versa. Equal weighting, when they rebalance that to 1%, everybody's equal weighting, so there's 500, so 0.2% into every stock there. As you can see, the RSP moved into correction territory back in the second quarter of this year and moved into it about 3 weeks ago as well. And it's down much more than the overall markets at this point. And again, the reason for this is a lot of the large cap stocks have been the leaders. They've been clearly leading the way. We've talked about this so much. So if your portfolio feels like it's underperforming the S&P 500 or NASDAQ 100, it likely is, unless you are extremely concentrated in some of the biggest companies out there, being the Apples, the Microsofts of the world. If you're not, you probably are underperforming. I also wanted to show you, the magnitude of this pullback. I said around 10%, about 9% hanging today, but hit about 10%. And keep in mind that this 10% correction in the S&P 500 typically occurs about every 1.6 years. It's called a year and a half. So corrections are they happen quite often. It's not something that when a correction happens, you should be freaking out because, again, if you're investing for 15 years, which is still short term, you're probably investing for much longer than that. But if you're investing for 15 years, based on the averages, you got about almost 10 corrections in that time frame. So it's going to happen. And you have bear markets that happen along the way as well. So let me show you here another chart. And this is pretty interesting. This comes from Charlie Biello over at Creative Planning. And it shows here, right, as I mentioned, intra-year decline of 10%. You can see it's the third line down. It happens about 63% of the time if you just look at an annual basis, going back nearly a century. And on average, about every 1.6 years. We can go up to 20%, and that's a bear market. It happens about 1 every 4 years. As you can see, on average, 1 every 4 years, 26% of the time, you will see that happen during the year. So what I want you to realize here, as a long-term investor, it's going to happen. This is not something that is rare. This is something that happens quite often and something that really shouldn't scare you, honestly. Maybe, it hurts when it hits your portfolio. I completely understand that. But it's not something, in my opinion, that you should be freaking out over by any means. Now, let's take a look at year to date. Let's kind of catch up where we've been. And we've talked about the market almost every show, but let's catch up because I think it's really important to show really the magnitude of kind of where we were to start the year, where we were at the highs earlier in July or so, July, August, and now where we are today. Kind of a lot going on here, but you can see that top line there. That's the Qs, NASDAQ 100, still heading into today up nearly 32%. Then we move down, the S&P up about 10%, heading into Tuesday's trading for the year, for 2023. Then we move down a little bit more, the Dow Jones Industrial Average up less than 1%. So let's call it break even. And then we move down even further, the RSP, the equal weight, is actually down over 3%. Again, so it's really underperforming the S&P 500 by 13% this year. That is a big, big, big difference in less than 12 months. Go down even further, down 5.5%. The Russell 2000 ETF, the IWM, that's the small mid-cap index. Small guys underperforming even more. And then if you look at the micro-cap index, this is IWC, down 14% year to date. You look at that compared to the NASDAQ 100, which is the 100 largest stocks in the NASDAQ composite, non-financials, again, basically the Mag 7, Apple, Microsoft, etc. There is a difference of about 45%. 45% difference. Think about how much that is based off a portfolio. And this is not even through 12 months. So this has been a wacky year. After 2022, which was a wacky year. In 2022, we had the 60-40 portfolio, 60% equities, 40% treasuries, have one of its worst years in the last century. The bond market, depending on what you look at, and a lot of analysts will say that was the worst year for the bond market since the Civil War. So we had a crazy 2022. 2023 is just as nuts. It's very rare to see 2 crazy years like this. And, a lot of people out there will say, we're on the precipice of this recession. Well, by the way, 1 year ago this week, they came out. The economists came out and basically they did a poll of all major economists, and there was a 100% chance that we were going to have a recession in the next year. Obviously, it didn't happen, so I could care less what the economists say. But people are still barking about a recession, and maybe we do have 2 quarters coming up next year of negative growth. Probably very shallow, very small. But a lot of that's priced in. We've seen the deterioration of many, many stocks outside of the big names. We've seen that. It's in the charts, folks. So for me, you have to kind of look at things in reality in these charts, not just what the NASDAQ's doing, the S&P's doing. Look at the reality of these charts. So here are a couple other asset classes outside of just a traditional stock market. Here we have Bitcoin, year to date up 107%. And I got to tell you, you look at it on the right side of this chart, how much it surged. Bitcoin has been extremely strong. We have a great guest coming up on Thursday, Scott Melker, the Wolf of Wall Street, he calls himself, really big into crypto. We're going to get his view on what's going on because I got to tell you, there's been a major breakout in Bitcoin. Ethereum may be next, and heading into next year where the halving is going to be happening probably mid-April, we could see a big, big move in Bitcoin in the next 12 to 18 months, in my opinion. Nothing's guaranteed, but we want to get some views of some people that really know Bitcoin well. We'll have Scott on Thursday's show. Also on this list here, you can see crude oil spot price up about 16.5% year to date. You can see the S&P I put back on there about 9.9, and then gold at 9.3. And gold went from basically 0 to 9.3 since the war that's going on between Israel and Hamas right now. So you take out kind of the craziness that we've had just in the last couple of weeks with the war. Gold had done nothing this year. Oil really hadn't done anything. It's rallied back because of the war as well. Bitcoin has been the strongest asset class, head and shoulders. So having some diversification in Bitcoin has really helped the portfolio this year quite a bit. So again, I just want to show you what asset classes are doing this year, because you think oftentimes just big picture, and you really kind of lose what's actually really going on. So that's where we stand with the markets right now. It's kind of no man's land for now. We have a Fed meeting. They're likely not going to raise interest rates coming up later this week. I don't think they raise it probably in December either. The move that we've seen in treasuries, a 10 and a 30 year, have really priced in another almost 50 basis points, in my opinion, to interest rates. So it's done the job of the Fed. So I don't think the Fed has to come out and raise the Fed funds rate, because I think the rise in interest rates in treasuries has already done that and has really slowed down the economy a little, hurt the jobs market a little. So I think this job's been done. So I think the Fed is done. They should be, because the market's done its job for it. It's pretty nice when the market does a job for the Fed. Now let's jump into the topic I want to talk about today. Many of you know I am a big fan of investing in big trends in the future. Electric vehicles still make up a very small percentage of sales. Here in the U.S., heading into this year, still single digits, mid-single digits of the amount of cars on the road, vehicles on the road that are actually purely electric, not hybrids, but purely electric plug-ins. Still very small. And as you know, many automakers and governments around the world are pushing by anywhere between 2035 and 2050 to have all production of vehicles be electric. All production, not hybrid, but electric. You're seeing that everywhere. However, in the last just month, folks, the headlines continue to come in. There has been some struggle. Everybody really, from Tesla to Ford, in the last couple of months, they've been issuing warnings about the slowdown in demand from consumers for EVs. The demand has slowed, even though the government's giving subsidies up to $7,500 check, basically, in the United States to buy certain electric vehicles. A guy, when I did TV back in the day, there's a guy by the name of Steve Moore, economist. I know I bash economists, and I haven't followed Steve much as of late, but I saw he was on Fox Business the other day and talking about EVs, and I thought it was pretty interesting. One of his quotes said, he talked about the Edsel, the Ford Edsel, where they made 500,000 of these Edsels, and it was supposed to be the next big car. Obviously, that didn't work out for Ford. It's been one of the biggest failures ever. He's really equating EVs to potentially being a flop like the Edsel. I'm not going that far. But here's a quote from Steve Moore. He said, "I'm here to tell you, if these trends continue, we're going to see the EV market become the next big flop because car buyers don't want them." And I gotta agree with him there. I don't think a lot of car buyers do want them. And it's not just, the statistics you see in the numbers. You do the old boots on the ground test. You ask your friends and family, that are buying cars, looking for cars, are they looking for a pure electric? Most aren't. Whether it be the range anxiety that there's not enough charging out there, whether it be that they just like the sound of a combustion engine. I don't know. It could be a lot of different things. Maybe it still scares the hell out of them. But the bottom line is there's definitely been some issues here, and demand's one issue. Even with subsidies, as I mentioned, demand is becoming an issue. We have inflation, and because costs of goods and services for the production of these EVs has become more expensive. So the auto companies are losing money on a lot of these EVs and have to raise prices on a lot. Even though you're seeing some people cut prices, Tesla being one of them, just to try to get EVs in the hands of consumers. But this is hurting the actual automakers at this point. Interest rates, cost of borrowing. If you're going to go out, you're going to buy a new auto, and you want to borrow and not put down cash, it costs a lot more. So you might go cheaper. You might go combustible engine, traditional, and not go EV because it's going to be cheaper. And then this is leading all the stuff I just talked about to a lot of projects that are being delayed. Everything from EV projects, we're going to talk about that in a minute, to battery projects. So I think the near term for electric vehicle stocks and related stocks could be murky. That being said, we're talking about the big picture before we wrap this all up. The big picture still remains positive. I don't doubt there's going to be more EVs on the road going forward in 2 years, 5 years, 10 years, 20 years from now. I don't see that ending anytime soon. However, I think the adoption is going to be slower than many of us have thought, especially governments and companies. So the Economist Intelligence Unit came out just recently, and they said that global energy consumption will be rising by 1.8% next year, which will be hitting a record high. At the same time, it's saying that demand for renewable energy is also expected to rise in 2024 by 11%. So again, you're still seeing huge growth for demand for renewable energy. Even talked about coal. They said coal demand is expected to remain at record highs this year. So you're seeing it on all levels. It's not just renewables. It's not just fossil fuels. You're seeing it on both. They did come out though and saying this is coming to the longer term. They came out and said that it's reiterated its forecast that global demand for oil, natural gas, and coal, fossil fuels, is set to peak before 2030, before the end of this decade. So do you really want to invest in fossil fuels and new fossil fuel projects if that is the case, where the peak demand will be done within the next 6 to 7 years? I don't know if I agree with that because I think the transition is taking longer. I've talked about this a lot, having the energy barbell. We invest in clean renewable energy as well as fossil fuels and dirty energy, because demand for fossil fuels is not going away. At the conference this past, I think it was 2 weeks ago now, in Vegas, the Stansberry annual conference, I talked about investment that I said, might be a bit irritating to people, might like kind of say, this guy's crazy. And it was coal stocks. I showed a chart of how strong coal stocks have been in demand for coal. And we talked about this right just a second ago. I don't see that slowing down anytime soon. Will it peak at some point? Yes, it will. However, the fossil fuels are holding their market share better than anybody expected, which again is hurting renewable energy projects. They're hurting investment in renewable energy, which kind of goes hand in hand with electric vehicles and the future of EVs. So let's take a look at a couple of companies that have come out as of late and talked about EVs and what's going on there. Talk about Ford here first. Their electric vehicle unit posted an EBIT, earnings before interest and taxes, a loss of $1.33 billion in the last quarter. That's up from a loss of $1.8 billion the prior quarter. So they're losing more money. They said they're going to cut the production of their Mustang Mach-E, which is an electric vehicle. That's not a good sign either. They also said they're scaling back about $12 billion in planned investments in the EV segment. That includes delaying a second battery project that they had in Kentucky, delaying that yet again. And again, that battery project is for EVs. Steve Morse said in this interview that Ford is losing somewhere between $40,000 to $60,000 per EV manufactured. That's not a very good business model. You don't want to be losing money. Granted, margins are slim when it comes to auto production, but losing that amount of money, you can get away with it for a little bit just to try to get the cars out there and then build up production, but that is a lot. They also said Ford said they're considering cutting a work shift at the plant that builds the F-150 Lightning pickup, which is, of course, the electric vehicle F-150. So, and again, they say this is due to demand. Demand is slowing for the F-150 Lightning. GM, its cousin. They don't really break down EV numbers specifically, but the quarterly profit in this last quarter was reduced by about $1.5 billion. They said this was based off higher costs and the impact of selling more EVs. Impact of selling more EVs, meaning they're losing money in every EV they're producing. They don't break it out, but they're losing money in every EV they produce. They had a goal they put out not too long ago that they want to be building 400,000 EVs from 2022 through mid 2024. Now they're said that the goal is they want to get to 1 million EVs of production total by the end of 2025. So they want to do that and hit margin targets. The margin targets might be tough. They didn't break down the margin targets, but again, they're shifting, moving the goalposts a little bit. They also came out, GM, this is GM I'm talking about. They're going to delay at least 3 EV models and the expansion of EV trucks by at least a year until mid 2025. It's a year and a half away, folks. They also came out just in last week. So GM and Honda had this deal where they were partnering up. They did it about a year and a half ago when they announced this project to bring out a line of lower cost EVs. They're going to use the GM. They have a battery, the next gen battery is called the Ultimum. They use that technology, and they're expected to produce millions of EVs with Honda that cost less than $30,000 for the global markets. And that was supposed to begin in 2027. They're ditching that partnership. Mercedes, they came out as of late and they said this is quote unquote a brutal electric vehicle market of heavy price cuts and supply chain issues would likely hit the lower end of its 12 to 14% adjusted return on sales forecast for the cars division as third quarter earnings fall. The CFO came out and said, this is a quote from the CFO, "I can hardly imagine a current status quo is fully sustainable for everybody." That's in reference to EVs and cutting prices. So Mercedes, Toyota, their chairman, a former CEO, Akito Toyoda, it's Toyoda, by the way, not OT. He came out and said, "People are finally seeing reality." That was his answer to ask when somebody asked him about the electric vehicle challenges and the slowdown demand in the U.S. And he also came out and said that they have to realize that there isn't a single answer to reducing carbon emissions. Its head of North America sales, also from Toyota, said that the market and demand for hybrids, so that's plug-in and gasoline, obviously, is smoking hot. And maybe they're talking their own book, because we all know that Toyota, even though they came with the Prius and basically they were the leader in hybrids, they've been really hesitant to go full-blown into electric vehicles. They've believed hybrids are the way to go, and maybe that is the way to go. And I feel like the hybrid market has been strong in the U.S. And Toyota has been kind of really smart to kind of hold off, and they've gotten a lot of grief for that. But they've been able to hold off on really pushing in. That being said, Toyota is working on a solid-state battery technology that they say could be mass-produced in the next couple of years. They also came out and said that could be charged in 10 minutes with a range up to 900 miles, basically more than double the range of any high-end battery right now. That would be a game changer, 100%. So before we get into kind of where we sit right now, where the future is for this and investments, let's take a look quickly at the return of the stocks here year to date. Some of the automakers I chose. You can see number one leading the way, even though it's pulled back a lot and now trading the lowest level since May, is Tesla. Still heading into today, up 60% year to date. Right below them is Stellantis. I think about Chrysler, up 38%, doing very well. Right there as well, 28% is BYD, which is now the leading seller of EVs, more than Tesla, a Chinese-based company. Warren Buffett invested into it many, many years ago. Really nice, solid company, up 28%. Toyota, I talked about, kind of avoided the whole EV thing and went stuck with hybrids and looking into solid state, up nearly 28% year to date, outperforming many. Nissan, up 23%. Then we move down. Mercedes Group, down about 2%. And there we go. Ford down nearly 9%, and GM down 18% year to date. So the big U.S. guys lagging behind, unfortunately. So that's kind of where we stand right now with the stock performance. But really, what's next? Are there going to be more subsidies on top of the already $7,500 per specific EVs here in the United States? What's going to happen to the battery companies? Because if demand for EVs is dropping, the demand for batteries is dropping. Though we need technology to move forward to make EVs even more efficient. So we need money to keep going there. And again, this is taxpayer money. This is our money as Americans. This taxpayer money is going to it. Do we want them to subsidize battery technology so we become the leader? Do we not? I mean, that's a question for another day. I can't even answer that. And it comes down to, are hybrids the answer for now? Could hybrids be the real winner the next couple of years? And I think they could be. I really do. And I'd have to say, if I had to pick a winner in there, I'm going to say Toyota. I think they're probably the winner when it comes to the hybrids. But that being said, it's been pretty negative on EVs for the last 15, 20 minutes. EV sales in the first half of this year, folks, still rose globally 49% year over year. Granted, last year, first 6 months, was up 63% year over year, but we're getting to bigger numbers. But 49% still really aggressive. And this is due to a research firm by the name of Canalys. Of all EVs sold in the first 6 months, 55% were sold in China. So you're seeing where the adoption has really been early on. We've talked about it a lot in China and will continue to be there. The EV penetration there is higher than anywhere in the world by far. So, looking forward, the issues that we have with EVs is the high cost. EVs typically cost more than typical combustion engine vehicles. The resources that go into building an EV, especially the batteries, really is something that's an issue, because whether it's lithium, whether it's nickel, whether it's cobalt, you name it, a lot of them come from really unstable countries. Prices can be volatile, and it makes the price of the vehicle and the battery be more expensive. Then we have the charging infrastructure issue. There's an issue where there's really not enough charging stations throughout the country. So that's an issue. And even if they do get to where they need to be, there's still this mental really gap that people need to jump over and not be concerned about the charging anxiety going forward. So it's, as I'm talking here, folks, I don't want it to say that the EV trend is dead. I just think we need to rethink it and realize there's other plays out there that could be interesting. I think it comes from a lot of different angles, whether it be, again, nothing here is a buy or sell recommendation. These are just education, giving thoughts to get in your head. Toyota could be one. Let me show you a chart right now of Toyota. This is a pretty darn good looking chart compared to a lot of other global automakers that are out there. So that's one maybe you want to consider. We also want to keep in mind that even though electricity is something that we're seeing everything electrified out there these days, that fossil fuels are here to stay. And I don't see them going away anytime soon. So I think when we look at investing in electric vehicles and renewable energy, we have to have that barbell. So I'm not saying you completely give up on EVs and give up on battery technology, because battery technology is going to change the world. It's going to. It's going to take time, but it's going to change the world. So you want to have some exposure to that over here. But you cannot ignore the fact that you need to have exposure on the other side to, let's call it fossil fuels, dirty energy. And maybe in the middle, there's that hybrid. There's the Toyotas and companies like that can really take advantage of both sides of it, that are playing this the right way. Stellantis, which is the old Chrysler, basically, Fiat. Look at a chart of this, how this has held up. This is started at STLA as a symbol. It's held up very, very well. Very similar to Toyota. So, a lot of times we as investors in the United States, we focus on Tesla or GM or Ford. We forget about other companies, like Toyota, which is one of the largest auto manufacturers in the world. Stellantis, which, based in Europe, a lot of people forget about that. We need to kind of start thinking outside the box. In the dirty side, maybe we look at some coal stocks. I'm probably going to do a show on some coal stocks coming up here soon, because in the presentation I gave at the conference, the amount of research I put into it, I want to share this with you, because I really think there's a lot of great opportunity in coal stocks. I know it sounds crazy, and I'm not saying it's a 10-year investment, but I think for the next couple of years, you could have some great opportunity in coal stocks. Even though they've run a lot, I think there's more upside, because they still are cheap, in my opinion. Again, just to wrap this up, EVs are not dead. They definitely hit a major speed bump, may have blown out a tire or two, but they will get fixed and they'll come back. But in the meantime, I think we need to really think about how we're going to invest for the next couple of years in this trend, and more importantly, longer term, and look at the timing and look at possibilities of reshifting a portfolio to be built. And I call this portfolio, let's call it the future of transportation. You can even call it the future of energy. And we can lump in fossil fuels, we can lump in renewable energy, and as well, some battery technology, and throw in some EVs and AVs along the way. But again, folks, thank you so much for watching. Remember, everything we do here is to educate you, have some damn fun, and of course, let's make some money here in the long term. So again, thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.